All right. Hey, Jim, thank you so much for joining me again on the Flipping Junkie podcast.
Yeah, I'm happy to be here, man. Thanks for having me.
Yeah. So we were talking, it was episode 46, I think is what we had said was, and I think this might be episode 147. Not
Almost 100 later. What do you know?
Yeah. So it's been a little while, and you've done some cool things and made some transitions and shifts to more of what you're passionate about. And I want to talk about that. For people that haven't heard that first episode, can you share with us your story about getting into real estate investing and what you've done so far in your career?
Sure. Like when I was on a podcast, that was about getting deals out of the MLS. And so that's where my career started. In 2005, I was an agent. And what's funny is my dad was an agent too. And so you think that would be easy for me to get into, just flow right in. The problem is when you get into being an agent, you work with, your friends and your family, your sphere of influence, and so that's who you call. The problem is all over, 98% of the people I knew used my father because he was a good agent, so my friends, my family. So I didn't have my family because they all used him. Of course, I had a couple of people that didn't really know him or use him, but I was like, what the hell do I do here? And so I found real estate investors. That's how I found them. I started kind of looking at creative stuff and going to some RIAs, which I didn't even know what it was back then. I just started, and that's how I found real estate investors. And I started working with them as an agent and then realizing very quickly, like, crap, I'm on the wrong side of this deal. These guys are making, 30, 40 a flip, and I'm making like 4 as the agent, and there's two sides of it. So maybe I'd make, 7 or something on the deal or 6. It wasn't bad as an agent, but I just realized I was on the wrong side of that. And so all I knew back then was the MLS. That's how I found all these deals. So for the first, 8 years of my career, the majority of my rehabs, I was primarily a rehabber. I've done over 500 transactions in my career. And I've been primarily a rehabber until a few years ago. I didn't shut that business down. I actually just did last year because in my market, it doesn't make sense right now. There's just too many people, too much HGTV for me, and, meaning people are overpaying, all the dreamers and all the people that, and it's great. It's awesome. It's, and I hope they're all doing well, but it's just not a time for me to be rehabbing anymore. So I shut that business down last year, but I've been studying multifamily for years, and that's what I got into a few years ago. But, going up, I would get, people always find it surprising. I got 75% of my deals out of the MLS, and that's still possible today. It's just, that's not the focus of my business anymore.
Yeah. So what did that look like? What made you say, hey, wait a minute, there's something here with this multifamily?
I'm from Chicago, right? I'm in suburban Chicago, Cook County specifically, and the rent rules here are out of control. They are so weighted in the tenant side, it is ridiculous. And so I started buying these 1, 2 duplexes, a couple of 3 flats, and it was a hard road to get to just to get to like 15. It took a long time, 1 at a time or 2, whatever. And then I stopped a couple of years ago. This is years and years ago. I stopped and went, I want to buy 10 at a time or 20. I didn't really know what I was looking to do exactly, but I wanted to buy more at once. I wanted to buy apartments or whatever. And so I, knowing that that's a big, I started looking more at how to do it, right? I started learning how to do it, talking to guys I know in the industry that are doing it, going to some, conferences and some, different seminars out and just learning, but really, because I knew it was big money and I could raise the money. From my life as a rehabber, I had access to private money, people I had worked with, and they were looking for me to spend that money for them because I wasn't doing as much of it because I was kind of slowing down my rehab business and started to do other things. And my kids are getting older, so I hang out with them a lot more. And so I was learning how to get into multifamily. I literally studied for about 3 years. Slowly, I wasn't like every day studying like college, but I was like really paying attention. And finally, some opportunities fell in my lap a few years ago, and I capitalized on them. And one we'll talk about during this call. But and that's it. The reason I got into multifamily was because the way I work, I'm like all or nothing with whatever I do, and buying 2 flats or 3 flat, whatever at a time just wasn't working for me. So I wanted to buy 10, 100 at a time. And so that's what I got into multifamily. And the first complex I bought was 91 units. And I met somebody at a mastermind, actually. It was random. Somebody sat at my table at lunch. I was by myself, because I'm kind of a loner. And I was sitting at lunch having all by myself, and they all came and sat at the tables around me, and somebody sat at my table who had a deal. And I talked about it like that if you're right on those numbers, that's a very good deal. And so I went out to Oklahoma the next week to look at it, because that's where it was, in Oklahoma. And I went out to look at it, and like, this is a deal. We should be doing this deal. And so we put it together. And so we got it, we bought it, we were able to get it. It was very distressed, kind of like a slumlord type situation. It was only 45% occupied. It had never been maintained in 30 years. I mean, nothing. The guy put as little money as possible into it. which is what I'm looking for in this business. You know, as far as, I mean, I want the under-maintained, the ones that haven't been properly managed or maintained for years. That's what I want to buy, because there's an opportunity there. You know, you can get those. I mean, there's a lot of rehab. There's a lot of money that has to go into it. But that's what I was studying. I was learning the right stuff to do. Where do you get the materials from? You know, do you use national contractors? If you have a $2 million rehab, like, who do you use for that? Because, you know, I've done lots of $80,000, $90,000 rehabs. I know how to do lots of those. Are easy for me to do. I know how to do every aspect of that. But a $2 million rehab, that's a different story. So I had to learn the ins and the outs of who you use for that kind of stuff. You know, and of course I interview 3 contractors for everything anyway. But now you're talking about scopes of work that aren't this big. They're, you know, that big, and so. The comparing the scopes takes a long time too. That's a part-time job in itself when you're doing that, because there's so much to compare apples to apples, you know?
Yeah. So how did, you know, what were the things that you were looking for? So you did all those years of research on this. And for anybody out there that's listening, that's, you know, doing some wholesaling or something, as a majority of people, doing some rehabs, they haven't really considered the multifamily because it's not something that they've learned much about. Can you condense, like, do that 3 years in 30 minutes?
Well, you know, what I realized is it's really the same stuff as you know, because I'm keeping these things. My goal is to keep them. Where my flips I was selling all of, right? They were retail flips, selling for as much as possible. And the rental stuff I was keeping was different, but my primary business was just selling everything. And so this I was evaluating to keep. And so on my rental stuff, all it was really, you know, I mean, this is a, you know, a very dumbed down version of it, but it's the same thing, but bigger, you know, bigger numbers, you know? And so of course you have to be more careful and really understand those numbers and the market rent and the cap rates and, you know, like, can you raise the rents? And that's a lot of what we do, is the rents. And a lot of these, a lot of operators we found around the country are just, you know, mom and pops that never knew what they were doing. And they're great people. They're not even slumlords. I bought mine from a slumlord, my first one. But they're just people that didn't maintain them right, or didn't know what they were doing, or thought they were doing the right stuff. And so they you know, they need a lot of work. They've been beat up over the years, and it's just there's lots of opportunity with it.
Yeah. So how do you analyze those financially? You know, you're not looking to sell them. You're not looking, you know, right away. So if you're wanting to hold them, you know, long term, you know, benefit.
Sure.
What are you doing? What's your analysis? Like for somebody that has no idea, you know, they know that this person wants to sell this, you know, 20 unit place that's half occupied, you know, just let's do an example.
Sure. So, okay. So yeah, like a 20, you know, or whatever, 100 unit place that's half occupied. Let's do the one that I bought. Right. So the rents were already, the 45% of the rents that were coming in were already about 30% too low for what the market could handle. But like this particular guy had like no maintenance, literally built into his lease. They do that. We're giving you a lower rent. It said this, not in this exact terms, but it's dumbed down. We're giving you a lower rent rate, so you take care of your own maintenance. That's what it literally said.
Really?
So, yeah, oh yeah.
That worked out wonderfully.
Oh God, it was a disaster. Well, and it's part of why, you know, that particular building I wholesale, because it was a huge job. And so, but that part of what I want to talk about on this call is that deal, and because we went through 2 buyers. One buyer lost a ridiculous amount of hard money because they couldn't perform. And so, you know, like that's part of what, like, you know, people that are getting into these deals that, you know, think they know what they're doing. And even if they're studying for all that time, but the first deal I did, I mean, I got to run for my money on that one. It was a 3-month flip that took 19 months. It was a quick wholesale that, yeah, it turned, I mean, it was, I mean, I'll explain it here in a minute, but I mean, that's so. But a basic deal, you know, we're looking at, okay, well, what are the average rents for? How many 1 bedrooms do you have? How many 2 bedrooms do you have? How many 3 bedrooms do you have? You know, what are those going to rent for, right? And so you figure out what 100% of what the potential rent is. And then we're usually working off like 90%, right? Because, you know, you don't ever have 100%. Even if you do, it's a bonus, but we're running numbers off a full 90% of what, you know, of what the rents will be when it's stabilized, rehabbed. And so that's how we're starting with the numbers, is basically, all right, what is this thing worth? And then the cap rates you're figuring out, you know, for the end loans and stuff you can get are based on what it can bring in. You know, in the market that you're in, are they lending at an 8 cap? Is it a 10 cap? Is it a 6 cap? I mean, you know, in a cap rate, for people who don't know what that is, that's just a percentage of profit you have, you know, for that particular deal. And so there's different markets, like in Seattle, for instance, there's people that are paying like 3%, or they will buy with a 3% cap rate, which is ridiculously low. But that's the way that market is right now. It's a market I would not even come close to touching. because they're not only are they paying they're paying top dollar, which is why they're only getting 3%. You know, and so in multifamily, most of the country, like let's go to normal parts of the country that aren't Seattle or aren't California or aren't stupid markets that have crazy prices. You know, like an 8% cap rate is pretty good. And so so what we're doing is we're taking all like the figure that we're using is 8% to come up with the end value, and then that's how we're basing what we're doing. So like I'll give you an example. I'm evaluating one right now. I'm going to put an LOI on one. It's 140 units, right? It is vacant, totally vacant. It has been vacant for 8 to 10 years. The purchase price is going to be around $1 million, and it will need about $3 million. And so we're literally going to put 3 times the amount into this. And so we'll be into it for 4. I actually said 4.5 million just because you never know. A big project like that's probably going to have a little more. We have some fudge in the 3 million already, but I put 5 on top of that, 500,000. So we're looking at 4.5 as an all in. Now that property, you know, as an 8 cap with the rents totaled up, we're talking about 7.5 real. That's conservative. 7.5 million as an end value. This is not something I plan on selling anyway. So the end value, while it's important just to, you know, to know what we can put into it without going over what, you know, budget is, because we take loans out in the end. And this is a fun part too that I'll talk about. That we cash these loans out, meaning we'll refi them when we're done, and the banks will give you, you know, an 80% refi. So if you're only into this thing for 60% total, you know, your all-in cost, you're at 60%, and you're going to do your final refi for 80. That 20% spread you get as non-taxable income, because it's not income. It's just you're pulling your equity out of your property. It's not income. So let's just say that that's $800,000 or $1 million, which is not uncommon. We just take that and the partners split it as our equity, and we pull it out, and the cash flow still pays for the building and still pays for the loan. So that is like literally tax-free money. And so that's a bonus at the end of all this. You're also going to get the cash flow from these things, but that's just a nice bonus. So that's a quick breakdown of that deal. I mean, it's $1 million in purchase price. It's going to cost, you know, $3 million in renovations. We'll be into it for 4. Let's just call it 45 for any kind of stuff that comes up at the end that we don't expect. I don't really expect that extra 500, but still, even with that extra 500,000, not just, you know, that's not a little bit of money. I'll still have $3 million in equity on this property, and that's the 7.5 is a conservative number. I run all my numbers low because I don't want to get caught. You know, why would I? This is too. The numbers are too big to what's the word I'm looking for? To embellish on my, like, oh, maybe it's worth 8.2, and that's actually possible, and it's actually pretty realistic. But I'm running them at 7.5 because I know that is absolutely, without question, a doable number. And if I'm into it for 4 or 5, I'm quite happy if it's worth 7.3, you know, and I'm keeping that thing, you know. So, you know, in that situation, you'll be able to pull out a little over $1 million, like 1.4 on that particular deal. So it's pretty good. And so that's how, in a nutshell, that's what we're doing with these multifamily. And so the one deal I did that I wholesaled, that I met somebody at that lunch. That particular deal, it was 91 units. We bought that for $1,250,000, which was a ridiculous price for 91 units, right? We bought it for $1,250,000. And that owner thought that, you know, he got us because the tax assessed value was 1.2. So he actually thought that he got, you know, at $50,000 more than us, and he even told the title company how he took us to the bank, you know, whatever he said. All excited.
Yeah. But
we sold it instantly for $2.6 million. Like, we put nothing into it, by the way. This was he just didn't know what he had. It was just, and he thought he screwed us. Like, he was like, ha ha ha, you know, and he took us to, and we literally had it sold before we closed for 2.6. And so, but yeah, I say we had it sold, Danny, but that's not necessarily the case, because that was the first buyer who they presented a 1031 exchange, cash deal, and we were supposed to close on Friday, a Friday in October. And these guys on Monday, they called us, we need a 30-day financing extension on a cash deal. So we were like, well, so obviously they can't close. So we either, you know, a new buyer is going to take 45, 60 days anyway. So we said, okay, if you put up another 40,000 in earnest money hard, we'll give you the 30-day financing extension, which you shouldn't even get because this is a cash deal. And they said, no more earnest money. We said, okay, no deal. We'll just keep your $40,000. So they turned out to be attorneys, and they scared the title company. And we didn't even like, to me, this was not that it's only $40,000 because I don't think $40,000 is a lot of money. We could have sued the title company because the title company gave their money back. They would not give it to us, and we were entitled to it. Oh, it was a joke. But they were attorneys, so they called and scared the title company into giving them well, they wouldn't give them. We had to sign off on it, and they eventually they liened our property with a lis pendant, like a foreclosure, which they're not allowed to do. But we had to go to court. And you know what? The way that I'm in my life these days, I don't want any negative anything. The 40,000 is not important for me enough to go to court 10 times to fight these guys that are clearly scumbags. I have no interest in doing that. I just signed off on the 40,000, said keep it, scumbags, go away. I mean, there's a time that I would fight the 40,000. This wasn't it because we had it sold again, and they filed a lien on it. So the only thing, I mean, I might have fought it, maybe, I don't even, but I wasn't interested in doing that because I don't want, that's just bad, bad blood, I want bad energy.
Energy's going the wrong way, yeah.
So we just signed them off, let them out of it. Scumbag guys, we know who they are, and we'll never deal with them again. But we already had a second buyer on the line. But the second buyer, who we're supposed to close at the end of December, this was in October, it ended with those guys. We had it sold already, closed at the end of December. So we were like, okay, and this is for 2.4 now, so 200,000 less, but still, we're still going to do okay. We bought it for $1,250,000, and so that guy had 50,000 earnest money. That was hard already, it was hard, and he asked for a 30-day extension. He said, okay. We said, okay, another $50,000, we'll give you an extension, which he gave it hard immediately.
Yeah.
So then he needed another one and another one. So we have $200,000. And the closing date came. We said, there's no more extensions. We can't keep extending. I don't want your money because I didn't want it. This was money he could never get back. Yeah. And he kept not being able to perform and not being able to get a loan. He could come up with his cash, and so anyway, long story short is he never ended up performing. And we gave him 3 months for free at the end. So that's why we held it for so long, because we were going, this guy kept giving us money. We had 150, then 200 grand. And I'm a businessman, but at the end, I didn't want to screw anybody. I'm like, you have 3 months to get a loan. If you can't get a loan in 3 months, I don't want any more of your money. We're done. I have to move on. He couldn't perform.
So you guys already had owned this property though. This wasn't something where you're delaying your closing with the original.
Yeah, we owned it. Yeah, I bought it. We closed on it. We were operating it. We were stabilizing it. Well,
I was gonna say, how did that work out? I'm sure that guy would have been pissed. Just kind of waiting, and you guys aren't closing because the other people aren't closing.
Oh yeah, no, we were ready. No, it was all. So it was on them. They couldn't get the funding. He thought it was going to be easier than it was, and I don't really know. At the end of the day, the deal never closed. We kept the 200 grand, which the asset was not making money. Yeah. So we needed that money to and then we ended up putting 40,000 that into the building just because at a point we kicked out all the riffraff because we were supposed to sell it right away. Yeah. And then the rent roll was way down from when we bought it. So even though it was riffraff, it was still bringing in an extra $10K a month, so we had to replace that $10K, except the units were crap. So we had to fix up the lowest hanging fruit, that we could to get at least the rent roll up high enough to get, to get it. The goal was to get it to 27,000, and which is where it was when we bought it. And so we got it back there after putting 40,000 into it. And then we found another buyer that did close on it for 2.3.
Nice.
And then, but our total profit on that deal, so it sucked. It was a 3-month flip that was supposed to, that ended up taking 19 months. Mm-hmm. We thought it was going to be done in 3 months, so that was the original plan. So things don't always go according to plan. However, this one still profited a little over $1 million. It was $1,060,000. Yeah, to be exact. And so it worked out. It worked out really good. I had two partners on the deal. And so I don't want people to think that was all me. Like I got all $1 million payday, which would have been nice, but it wasn't all that. But either way, that it did end up working out. It was a long road, but that deal worked out really good.
Right. No, that's awesome. So you had mentioned the 140 unit one and working those deals. What are some things that people, that I would consider something that would be something we'd have to figure out is, these higher dollar amounts, you're talking about 4.5 mil into that with the purchase and rehab of the 140 unit. How are you putting together money to buy these?
Well, that is a very good question. There's lots of lending sources out there right now that are looking to put money into multifamily, a lot. And so it just getting to the right lenders. And the lenders have to, it's relational, a lot of them. Even with the institutional lenders, I don't go to conventional banks, by the way. I mean, you can, that's a way, but they want 35% down in order for you not to have a personal guarantee. And that's fine. You know, I have to put a personal guarantee on it. I mean, I'm doing the deal. I believe in the deal. I would prefer not to put a personal guarantee on it, but if I have to, I have to.
Yeah.
We do try to avoid that. So we work with a lot of funds that have, you know, billions of dollars to put into these things, and then we can get away from personal guarantees that way, or we'll structure a deal with, you know, a bank or a fund of some sort where we then we'll borrow a down payment. You know, like, so we bring in a private lender that is, you know, if we need 20% down, we'll borrow that from a private lender, and then we'll make them a 20% partner in that deal. They're silent. They have nothing, but they have 20% equity stake. They're a real partner. Any cash flow that comes out, any profit that comes out, they're a 20% partner. So that's generally how we do it. We'll take, you know, and I have, like, again, for my rehabbing days, I rehabbed since, you know, 2007. I've been rehabbing. I had a lot of private lenders. You know, towards the end, when you've been doing it a long time, you have people throwing money at you because they know you're good for it. You know, like, I even lost money on, I didn't make money in every rehab I did. Some got caught and things cost more, whatever.
Well, you still pay the lender. Yeah.
30 grand on one. I still, obviously, I paid it, made good to my lender because it's not my lender's fault, and I want to borrow his money again, you know? And so because I've done stuff like that, I've built really strong relationships with private lenders over the years. And so now, instead of them lending on one rehab that I was doing, I've transitioned them, and some of them weren't comfortable with it at first, but now I've showed them that, you know, the breakdown of how it all works and how they're tied and how they're, you know, they're an owner so they're tied to the property, and they're all okay with it. I've got it. So we're doing a combination of things depending on the lender, depending on the deal. I mean, there's deals that we'll have that we have lenders that will give us virtually 100% of the financing for because we have a record. So we don't have to raise that much, and then we don't have to bring in a partner for 20%. Now, I'm not opposed to it because a lot of the partners have actually been friends of mine now. A lot of these people I've known for years, and so I'm happy to bring them in these deals because it's a great opportunity for them, you know.
Yeah.
And I've had family members that know what I do now, and they're like, can I? And I never borrowed money from family before because I didn't really like, you know, and on the rehab side, I don't know, I didn't feel comfortable. I wanted to borrow money from people that weren't my direct family. But now these are really good opportunities. So now I'm actually going to my family that I know that have money, like, hey, I have another one. This is a great opportunity. You're 20% silent partner. We're going to play, you know, when we cash out $1 million, you're going to get 200,000 of that. Their down payment might only been 400, and so they're going to get 200 back, and then they're still getting 20% cash flow. And when we sell it, they get 20% of the profit. You know, it's a pretty good deal.
Yeah. No, it sounds awesome.
There hasn't been too many people I've approached with it. They were skeptical because they didn't know about it because they had only done on the single family stuff. But once I, you know, broke it down, especially the savvy guys were like, I'm in. Let's do it. You got one? I can go on title. I'm going to go on they go on as a second loan. So they're totally protected, you know. And so it's a no-brainer. It's a good deal for people.
Yeah, nice. So what about the management of these properties? And I was just working out, you know, to make sure that, you know, the management, and, you know, I mean, I'm sure you don't want a bunch of headaches, right? Like the numbers always look great, but what's the real world situation with management and all this kind of stuff?
I don't want to be a property manager. I don't want to coach my property manager. I want nothing to do with property management, but I'm buying apartments. So what does that tell you? You know, instead of systems, right? Like anything. Yeah. And that's what stopped me from doing it for years, to be perfectly honest, was the property management, because all I had in my head always was property management is 24/7. You know, leaks can happen in middle, you know, like when you're dealing with hundreds of units, you know, obviously it's easy for stuff to happen all the time, middle of the night, whenever. And so what I realized through the research that I've done over the years, that there's a sweet spot at about a minimum of 90 units so that's my minimum that I wanted. 90 units is minimum. And at 90 units, you can afford to have a full-time and part-time property manager on site, like an employee that works for me, versus having a third-party company. I've tested third-party companies before, and you know, nobody's ever going to watch your asset as good as you do. It's just the way it is. I mean, and so I tried it. I had a bad experience. I had another, it wasn't so great. I ended that one with it was a national management company because I buy these things all over the place, you know? Yeah. And so that's what I've realized now in the last year is just 90 or more units. And that way I can have my own staff on site. And so we hire a good property manager. Like I've actually taken a couple from the previous owner. They weren't happy working for them. And I just said, hey, I'm hiring somebody. I said, I'm not asking you to come work for me. If you're not happy with what you're doing, you're obviously not going to have a job here anymore, because you're going to go with your current owner. I said, if you want to interview or talk to me, and it's worked out pretty well. I mean, we've taken a couple property managers that weren't happy with their previous owners, weren't paying enough. We gave them good raises, so they're really happy to come work for us, and that's been very successful.
Yeah. And do you guys have any sort of checks and balances on that where you're you've got a plan to keep an eye on whether things are going, north or south?
So that's what I do. Like, so I deal with my property managers. I mean, I go on site every other week. I'll be on to the units at least once a month myself. At least, and so during the rehab, I go every 2 weeks, only for a day, just to check, show my face, make sure I see what's going on with my own eyes. But otherwise, I have a weekly call with my property managers, not all at the same time, all independently. So that way we can go through what's going on, where the rents are at, where's the rent roll, where's the delinquency, are there any evictions, who's screwing around, all that stuff we talk every week. So it's not you keep. I was doing it every 2 weeks, and that wasn't enough. Like, I have to really stay on top of them, because plus they got to feel like they're not on their own completely. This is not their complex, and so I found that the weekly call with them, even it's a 15-minute call sometimes. It's not, and I take it from the car. It's not like but still that call every week where I am talking to them about what's going on, helping them, giving advice has been extremely important and
Nice.
beneficial. So I wasn't doing that originally, at least not as often as I am now.
Yeah, because I mean, things, if it's not kept an eye on, right? Like, you could go a year thinking this is great and cash flowing, but like, oh, the numbers are changing. And I guess, is that like something that's sort of like, when you're getting those reports or getting the financials and you're seeing the vacancy rate, you kind of see when things are changing, right?
Oh yeah, for sure. We know. And when you rehab up, when you take an area that, like this, with these complexes that we're doing are all, they've been crap for years. They're just not that nice or whatever. And then all of a sudden you're putting all this money into them. They rent like this because everybody wants a new unit, And so we're making it. It's not over the top nice, but they're very nice. We're putting granite in all of them because everybody loves granite. We use life-proof flooring, which is unbelievable. That stuff is fantastic. And so it's like we use a gray wood look, but
Yeah.
it is like concrete board. It is incredibly durable, lifetime warranty. And so it's not cheap, but it lasts forever, and we have a lifetime warranty on it. So that's the stuff we use for everything. And the buildings the units look sharp. White cabinets, gray granite, we use gray walls. They look nice.
Nice. So so you're doing this all over the country, right? How are you doing this all over the country? Are you having to, what are you doing with this? Like, how are you doing that?
As far as just like, how are we doing? Because that's why, like, I'm looking to meet local operators for more deals. Like, that's part of what I'm on this for, to talk about the deals that I've done. But also what I've realized is there's a lot of people that have these deals all over the country. Like, they have these multifamily deals. They just don't know how to do them. They don't, or they do. They're like, but they don't know how to get them financed, or they can't get them financed. And that's what I can do. And so I can come in and bring the financing to the table. I can bring the expertise of how to rehab them to the table, and they can stay on as a property manager, or as the outside, they're a partner in the deal. And so that's really what I'm looking for. And that's how I'm able to do it around the country, is having local operators that want to stay in these deals and want to even manage them. Like that's also a lot of. So we, like, on the ones that I have now, I have property managers that I've hired, right, that are in place, that don't have anything to do with the ownership. But then there's deals like the deal that I was talking about, the 140. That will be somebody that the guy that brought me the deal will end up being the on-site property manager, because that's how that deal is going to work. And so that's how we're doing it, is having somebody who has skin in the game, or has not even skin in the game per se, because we're not always putting money in ourselves. We're actually trying to do that as little as possible, but somebody who has an ownership interest in the profit.
Yeah.
And that's been very effective. And so that's how we're doing it, is meeting people around the country that have deals or that know of deals. And so I will tell you that a lot of the times the deals get brought to me, like we're trying to kill every deal, right? That's the goal of multifamily, is kill the deal until you can't. If you can't kill it, it's a deal, right? And so we're killing about 95% of them, because they're not deals. They're just not. And but the 5% that are usually pretty good deals. And so we're having to evaluate and look at a lot. And a lot of people come and they think they have a really good deal, but it's just not.
Tell us what you want. Like, if somebody's out there has, a potential multifamily that you would be interested in, what are you going to ask them for? And then what's going to, make you say, yes, this is a good deal versus this is not a good deal?
Well, I got to see the numbers. I got to see the rents, the market rents now, the market rents, what the potential are. I look all that stuff up on my own too, but that's when somebody presents a package to me of, hey, I have a deal, and this is what I need. I need the financials. I need as much information about the property currently, as far as, and all the expenses, what the current rent roll is, what the rents are right now, and what they think the potential rents are. Once it's stabilized, because usually there's a 20% increase. It's pretty easy to do on a place that's not maintained, and sometimes even 30%, depending on how bad it is and how low it is. Because we were able to raise ours about 30% on that. The one unit I'm doing, I have a 105 unit we're rehabbing right now, and the rents will end up being at the end about 30% higher than they were just from renovating it. You got to kick out the riffraff too. You got to get out the bad seeds. There's a lot of these have people in there that you just don't want, that are selling stuff out of their apartment that you don't want, and so it's got to clean up. And once you clean it up, I mean, those are people that are paying rent because they want to stay there. So it's hard to lose that income, but it also, those are not the people you want when you're restabilizing an asset like these.
Yeah. Nice. So what, anybody out there that's got something they want to run it by you, how can people get in touch with you to see if that's something that you'd be interested in?
Well, they just email me. I don't have a big website. This is me, right? This is what I do. And the older I've gotten, and we talked about this, before the interview, the older I've gotten, the more I kind of want to lay low and, stay behind the scenes. And I don't want people to, I don't want to be some big guru by any means. And so the only way you can really get a hold of me is my email. You'll put it up. It's jim@jimhuntzicker.com. That's how I want people to, email me your deals, email me. And we'll talk. We'll see. I'll evaluate them. I'll my team evaluate them. But usually what happens with these is if it's a deal or it's close to a deal, I come out and I take a look at it immediately, because this is what we're doing. We're buying as many as possible right now.
Yeah.
I have a lot of money behind me to buy these, literally hundreds of millions to billions of dollars. So we can buy as many as I can find right now.
Nice. Yeah. So this isn't something where, Jim's wanting you to reach out and get some training on this kind of stuff, or a course to buy or anything like that. He's just wanting to see, let's partner up if it's a good deal, and however you guys decide to do this.
Training will come with learning by experience. I guess there is training, because you're going to be involved in the deal. There's going to be some direction on what you have to do. You're going to learn the entire process. But this is not like, call me, you pay me $1,000 for my course or something, and then you learn, and then maybe you can partner with me. Like if you bring me a deal and I think it's a deal, we're going to partner on it. That's the way it is. And I'll walk you through everything you need to do. Yeah.
And then we had agreed on that 10% affiliate commission on all the multifamily properties deals that are done, right? So
right. We'll have to work that out later.
No, I wish. No, but Jim's a good friend. I don't mind having him on here, and I know he's a good guy.
Thank you.
And definitely recommend, if you are interested in that, you've got something that you're looking at, and reach out to him and find out what might be able to work out. Do you have anything else you want to tell anybody out there listening?
I know,
this is sign off.
Multifamily. Everybody realizes there's a great opportunity in multifamily, and there is. Stuff I'm looking for is really there's a few things. It's distressed assets that are really beat up. They're undermanaged, undermaintained, just not. But also nice ones that have 80% occupancy. There's an opportunity there that the rents are sometimes 20% too low, and you could just over a year's time kind of raise those rents up and really increase the value of the property. And so, if you see an asset like that that's not maybe so beat up, but it's distressed in the way they're not charging enough rent. There's a lot of mom and pops that are running multifamilies around the country that they're just nice people, and they're charging way too low rents because they think they're just nice people and they want to charge low rents. And that's fine for them, but I'm a businessman and I'm in business to make money. And if the rents are too low, I'm going to raise them, and so there's an opportunity there too. So bring me any deal. It doesn't have to be beat up. It doesn't have to be vacant. It could just be something that might be, the rents are too low and there's an opportunity to restabilize with just the rents alone. There's always some CapEx we put in, or some renovations we'll put into it to spruce it up a little bit, some landscaping, and there's always something we do to change it. Sometimes we change the sign, the name, even depending on how bad the place is. There's lots of little tricks we have to put it on the map and make it look nicer. But they notice. I mean, every one of them I've done, people, even the town, the cities, they see that you're doing this, and they really obviously they like it because we're improving their communities. And so you get a lot of help from the community too when they see that you're really improving these things and trying to make a difference. It's awesome.
Nice. All right. Well, thanks a lot, Jim, for being on and sharing the stories and how you're looking at these things. And good luck to you.
Yep. Yeah, man. Thanks for having me. I appreciate it.
Yep. Have a good one.
All right. You too.